Look at the second PowerPoint on the chart of accounts, the accounting equation, which are things that we use when we're analyzing transactions. To review over from the first PowerPoint, we have the fact that we have businesses and personal assets and liabilities, and we have to separate them out. We're only analyzing what happens to the business assets and the business liabilities and the business equity, not the individual. So the personal assets and liabilities are not part of the chart of accounts. And when we're analyzing transactions, we look from the eyes of the business. Business uses accounts to keep track of business transactions. When we have business transactions, we have an economic event that has a direct impact on the business. And it requires something that the business is going to give up, and that's going to be equal to something that the business is going to receive. That becomes a business transaction, and then we have to analyze it and figure out how to record it into the books. And we're going to use accounts. When we record it into the books, we're going to use accounts. Those accounts are going to be on a chart of accounts. We ask 3 questions when we're analyzing transactions. We showed that back in the previous PowerPoint. The second of those questions is, which account off the chart of accounts are we going to use when we're recording these transactions? Each company has its own chart of accounts, but all chart of accounts are made the same way. Accounts are separated into 5 main ways or types. These are the 5 types: assets, liabilities, owner's equity, revenues, and expenses. And so in this PowerPoint, set of PowerPoints, we're going to take a closer look at revenues and expenses, which are subsets of owner's equity accounts. Here was an example of a chart of accounts that we looked at in the past PowerPoint, where we have a whole thing of assets are always listed first, liabilities are listed second, owner's equity, then revenues, then expenses. Assets were items that are owned by a business that provide future benefit. Liabilities are where we owe out to others. And owner's equity is what left over. If we take the assets and we pay off all the debts to the creditors, the liabilities, what is left over that the owner could take away, that's owner's equity. And it can also be called the net worth. The account that we put the owner's equity into is the owner's capital account. The creditor has the first claim against any assets. So if the business is going to go bankrupt, the creditors get to take away the assets first. They get to repo stuff first. And only what is left over goes to the owner's equity. So here was the example that we looked at in the previous PowerPoint. If the company has total assets of $100,000, liabilities of $60,000, what is the owner's equity? So our formula was to take the assets subtract out the liabilities, and what we have left over that the owners could take away of the assets is the owner's equity, in this case $40,000. Now we can take that formula and move it around and have assets equals liabilities plus owner's equity, and that is the preferred accounting equation. So whenever we say the accounting equation, this is how we normally put it. That doesn't mean that assets minus liabilities equals owner's equity is wrong. It's still the accounting equation as well. It's just been rearranged a little. But the preferred way is A equals L plus E. Okay, so when we look at owner's equity transactions, there are 4 types of things that can happen to owner's equity. So the owners themselves can affect owner's equity. They can increase owner's equity by adding money or other assets into the business. So if I want to start my own business and I'm going to start a checking account at the bank that's in the business's name, I'm going to take some money out of my own personal checking account and I'm going to invest it into the business's checking account. So that is me, the owner, investing personal assets into the business. So that increases the owner's equity. I will now have more owner's equity because I've increased the owner's equity by increasing the assets that the business owns. Now, the owner can also decrease the owner's equity by taking money back out. So as the owner, I can go to the business checking account and take money out of it and go spend it on my own personal groceries and gas for my car. Okay, and so that is considered an owner withdrawal. That's going to decrease. I'm decreasing the assets because the business owns that checking account, and now it's being decreased, and the owner's equity is also being decreased. Now, besides the owners increasing and decreasing the owner's equity, the business itself can increase and decrease the owner's equity. And so the business can increase the owner's equity by having revenues. Revenues happen when the business sells stuff. So whenever the business sells products or sells services, then that's going to end up increasing the owner's equity. The business is also going to have expenses. That happens when the business uses stuff. So the business uses electricity, it uses employees, it uses office space. Whenever it uses stuff, it has expenses, and whenever the business has expenses, that's going to lower the amount of owner's equity that there is available for the owner. Okay, so let's take a look at each one of these 4 things separately. The owner investments, the owner withdrawals, the business increase, which is revenues, the business decrease, which is expenses. So when we have the owner's investment, that's the owner putting in or investing cash or other assets. We can put in equipment into the business. That's going to increase the owner's equity and of the business, and the assets of the business are both going to be increased. Okay, and we're going to use the capital account when we're actually recording that into the books. Okay, the owner's equity part is going to go into the capital account. Capital account is listed as the owner's name, comma, capital. So if I had my own business, then I would have Dr. Dooley, comma, capital would be listed as my owner's equity capital account. And if I invested money into the business, I would have an increase into the asset called cash because the checking account just increased, okay, that the business owns, but I would also increase Dr. Dooley, comma, capital because that would increase as well. My equity in the business would have increased. Now, owner withdrawals are when the owner is taking cash or other assets away from the business. So that if I go to the checking account and I write out a check to myself, okay, and then I use that money to pay for my personal house rent or something, then I am withdrawing it from the business. That's going to reduce the business's owner's equity to me, and it also reduces the assets that the business owns. The checking account now has less money in it than it did before, and the owner's equity, the equity that belongs to the owner, okay, is now less than it was. Okay, now the account that we're going to use is either, it might be called a drawing account, or it might be called the withdrawing account or withdrawals account. Okay, and again, just like the capital account, it would have the owner name, comma, and then either drawing or withdrawals. So Dr. Dooley, comma, drawing would be the name of the account on the chart of accounts. Now, revenues and expenses, their accounts, again, we mentioned this before, that are subtypes of owner's equity. And revenues are accounts for when we have sales of products or services, and expenses are accounts when the business uses products or services. In the next section of the YouTube video, we will delve deeper into revenues and expenses.